Good morning, everyone. Welcome to another investing live stream. So today we're going to get right into a type of property that I'd like to start by talking about, which is one that I don't like investing in. And I'll give you a very, very simple reason as to why I don't like that. Then we're going to start with some Discord questions here, and we'll get right into some deal analysis as well. So here's the bottom line. There's a listing that I have that we did a quick renovation on. Not really. I don't even like to call them renovations. Basically, seller came to me, trust-owned property, total disaster, and we cleared everything out, did the basics. Right? You should already think to yourself, what does Kevin mean by the basics? Think. Edgecombe gray, Swiss coffee on the paint, clean up, get all the junk out, do a little bit of grass, a little bit of mulch, paint the outside, light fixtures, plumbing fixtures, pretty much call it a day after that, and appliances. That's it. Problem is, I took this listing on in probably like, in this particular city, so within the scope of the city, probably, I don't know, a lower class neighborhood. So, you may have heard before, I don't really like using these. I think they're kind of arbitrary, but you may have heard of the terms before where people are like, oh, that's an A-class neighborhood, B, C, D, right? So on down the line. This is probably going to be somewhere around the C, D level. And it just has now been, within the last 2 weeks, been broken into twice. It gets vandalized because people know it's empty. People go use it like it's a public restroom. And no matter how much the owners give us in terms of latitude for adding locks or whatever, until they replace all of the windows in the house, that place is never going to be secure. It has these old like crankshaft windows. It's just mind blowing to me that I've never had that happen before. I mean, twice. And anytime this has ever happened before, like a single time or a minor thing, it's always in the CDs. Again, this isn't to say these are bad areas to invest in. Although that is kind of what the title is, it's more to say that it's a headache. And me personally, I like investing where there are less headaches. And if I could get a good wedge deal in a B or C neighborhood, I'd much rather go there. So that's a little bit sort of my point of view at least. Maybe you have a different experience on that, but my thought. So, all right, now let's do this. We've got a few questions here in the Discord chat. Then we'll jump on over and. We'll hop on into some deal analysis. So let's see what we got here, and we'll get started. All right, so in our Discord chat, and if you can, give me a little thumbs up that you can hear me okay. Let's make sure everything is going good with our live stream really quickly. And yeah, if you can give me, I know that it's a little bit of a quiet live stream this morning. But let me just make sure. There's no crazy like echo or anything? Sure. No? Okay, everything's good. All right, good. Moving into deal analysis and some questions. So one of the questions I have here is from the personal finance section. I always like trying to help y'all out with personal finances too. So we're going to start with this question here. It's Vetements over in personal finance. Here, I can go ahead and actually, we'll do a quick little screen share here. Thank you so much for saying that. So let's do a screen share here. We've got Vetements asks, hey Kevin, I'm a current college student with 2 years till I graduate. I have some money saved and continue to add it to whatever I can. I work part-time and have an extremely low income while going to school and wouldn't be able to qualify for a loan. Have about $35K cash sitting in a savings account. Median home price is about $150K. I'm wondering if you feel I should put the money in something specific aside from a savings account. And if so, what do I suggest or continue to hold while you work on increasing your income? Yeah, so great question. It's actually my very first year in real estate. I made $35,000, and that very first year, I started the year out making no money. I actually ended up co-signing with my father, and we put 3.5% down on a $300,000 property. And I knew that my income would be enough, along with Lauren's ability to generate income by the end of the year, that we wouldn't have trouble making the $1,900 per month payment. So, in a case like yours, I don't know necessarily, obviously, sometimes it can be personal. Hey, Peyton, what's up? But, you want to maybe ask yourself, is there a way that you can open the door to investing with a family member to get into real estate, to where you can buy a 3-bedroom, 2-bath, something for 150 grand, and then rent out a couple of the rooms, really minimize your payment, and make it so that your 35 grand is affordable while you're going to school. And, while at the same time you're starting to build that investment portfolio, you're starting to wrap your head around actually being in real estate. There's a huge value to actually being in the deal. And so, that might be a consideration to me. Otherwise, what I did before I invested in real estate is what I would encourage is absolutely, if you're going to leave your money in savings, at least move it on over to like an Allied Bank or something where you're getting at least 2% back on your money. Maybe at least, even if that matches inflation, whatever, get that 2%. Then the thing that I did is this is probably a bad thing with how volatile things are now. Maybe I just got lucky, but I took the money that I had, which was maybe only like $6,000 to $10,000 at the time, and I just kept throwing it all into Apple stock, which was back, this is a long time ago, so back when things were still like consistently up for Apple, and I sold up, and it ended up probably around, after I had kept contributing to it, right? So I ended up getting to around 30K, and I used that to help with the down payment, but also to pay off my Toyota Prius. Which helped me then qualify for more real estate when it came time for rental time and moving on to the next deal, so to speak. So some considerations for you there. Now I want to jump on over to another question we have here, and BG actually has a very good question. The question is here. Let's press that button. There we go. On your investor course, you mentioned that the agent should be doing things like calling the listing agent and probing for details. How are you supposed to manage the agent? Did you ask blank? From the outside, I feel left in the dark as to what my agent is doing, and so on and so forth. So here's the thing. Let me give you an example. There are two sort of types of agents, and then there are sort of two types of agents beyond that. And here's what I mean by that. There's a type of agent that invests in real estate, and then there's one that doesn't. The type of agent that's a deal maker, a hustler that's constantly investing in real estate, they know the questions to ask. And with that particular person, you'll know if they asked or not. And that sounds like astronaut. The way you'll know if they asked the questions or not is the information they provide you. So for example, you say, hey, I'm interested in this deal. Is there a way we can, do whatever we could do to screen this deal? Give me your opinion on it. What do you think about it? Is it a good location, bad location? I wouldn't necessarily start by going, oh, can you run the comps on it? I would always start with, can you go fish for information from the listing agent? Let them run with it. Then let them come back to you and say, hey, this is what I found out. So let's see. I'm just trying to think. And I was sorry. I was just listening to see if there was a weird echo, but it sounds like everything's okay with the audio. Okay. So and what I would specifically say is when they call back and say, okay, hey, you know what? I talked with the other agent. Doesn't sound like there are any offers, or it sounds like there are 1 or 2 offers, whatever they might come back with. Then you should be thinking to yourself, okay, what else? Is that all they asked? Ideally, they get more information than were there any offers or how many offers are there. Ideally, you really want to find out, okay, did the agent find out why they're selling? What are they looking for? Fast escrow, short escrow? Who do they want for escrow and title or attorneys? What special circumstances are there? Have they done any reports? The termite, the sewer? If there are offers, where are those offers? And where can I get some more detail? Ideally, the agent themselves will provide you that kind of information automatically. And then okay, cool. If your agent comes back to you and says, here's all the information I got, and it addresses all those things, well, then you've got somebody who's asking the right questions. If they just come back to you and go, yeah, no offers. Is that all you got? That's not so ideal, right? So that would be the best test, because then, as I wanted to mention, is you have two kinds of agents. You have the agents that they kind of don't really, it's easier to describe this with attorneys. So if you have two attorneys, one attorney might carbon copy you on literally every step they take. And it's very transparent because you literally see everything they do for you. You see how they're fighting for you. Everything's transparent, or they blind copy you. I don't blind copy all my clients all the time, not at all, but I keep them updated, right? So there's that kind of person that keeps you updated with exactly what's going on. And then there's kind of the agent that just waits for you to call them. Not so ideal, right? So I think that's the best way to revise rather than necessarily going right off the bat, hey, did you ask this? You might instead say, well, what information did you gather? Hey, what about this if we were going to write an offer? What about termite? What about sewer? What about, escrow title? What are their preferences? And kind of come from that angle. So that's another POV there for you on that. So let's see whatever we got. We got a Financial Freedom posted a deal analysis here in the general. Remember, it's good to post these in the actual deal analysis. We'll see if we can get back to this. So let's just look at some other questions here. Let's see. Houses are okay. So here's a question. So Rambling has this question. It sounds like it's a little bit more of a concern, and then we'll also respond to your questions here in the live stream. Houses are being, are going pending quicker than the agent can set up a showing for me to check out the house. Don't let yourselves get discouraged. This is very common in competitive markets. So do not let any of that discourage you. It's really not that big of a deal. You'll find one. So check out, as far as buying houses as is, every sale is as is. Check out the lectures that I have for as is. So we're going to jump around over here to deal analysis escrows. We'll also, make sure to check in with y'all here. Welcome, Michael. Awesome. Congratulations. Welcome on in. So it looks like these were the deal analyses that we analyzed last time. Remember, when you are in escrow or you're just writing offers, you can actually post your docs here under deal analysis, and that's where you'll get sort of priority deal analysis. So congratulations to those of you moving along in deals. Let's get on over to actual deal analysis. Good, Financial Freedom, you posted here. And last person that we responded to was Abel. So Rambling has another post. Let me see. Okay, good, Financial, you moved yours over here. Please check out this house and give me your opinion. I promise you I'm searching hard. Deals get snatched up before I have the opportunity Yeah, I mean, look, the thing is, you got to do not rely on me. Look, let's just be very clear here, Rambling. I am not your agent, right? So if you can't rely on me to get you an answer on a deal that you posted 4 days ago and then expect it not to go pending. It doesn't work that way. What the way real estate works is if you take the education from the lectures and from the course, and you're working with your agent, you look at these deals, you have your pre-approval letter ready, and then you write an offer. You find the deal, you run the comps, you take all of the information that you've learned from the lectures, but then also the other live streams that we've done. I mean, it's very repetitive, kind of the way I analyze these deals. It should be very predictable what I'm going to do first when I click on deals. And then write an offer. Get it in. Let's see you actually put pen to paper. Because right now, you've got deals every day in the deal analysis, but you've not written an offer yet. So let's get you writing some offers. So let's see what we've got here. 295K property. We've been looking at the deals in Georgia. You've been looking at quite a few different ones. They've just had a price reduction on this. This might be good. This could be good for you because it might be less competitive, right? When you have a property that has been on the market, let's see, since March 25th, and they priced it at this stupid price of $305. I mean, come on, it's dumb. They blew the marketing splash, so to speak, by listing it for $305 instead of $299. Blows my mind that they would do that. So sure enough, now they've dropped the price. Let's screen share here. Now they've dropped the price. Take a look at this. There you go. You can see here, this is just very clearly here listed on Zillow. You just scroll down the side, you go over here to history, find out what's going on. I'm just shocked. Okay, fine, Redfin did it for $305. I'm shocked anybody would list it for $305. Really, should have been $299. I mean, that's just a seller ego stroke right there. right? But you've got, that's some crazy texturing on the ceiling. Take a look at that. But what do we got here? Acoustic ceiling. We've got this flooring, kitchen, the original cabinets. So let's continue on here. What we've got, the wainscoting. Okay, so I mean, this is a pretty move-in ready deal, right? Those were still the original cabinets. You can see that these are the same cabinets that they had in the kitchen. They just painted them. So, brass hardware. Okay. Yeah, I mean, look, this is pretty easy, right? This should be pretty easy for you to run the comps on. You know how I run the comps in your areas. So, it seems like you're actually kind of at the dead end of 2 cul-de-sacs here. That's pretty cool. Look at that. I mean, I guess you could go out this way, but cul-de-sac, cul-de-sac. I mean, I like that. Oh, yeah, that's nice. Okay, awesome. Yeah, I mean, look, you should know exactly how to run the comps on this. Get started on that. We're going to keep moving along here in the deal analyses. But let's say that we responded. When did we respond to that one? Probably somewhere around check around 15 min in. And let's get on over to Peyton, who is, I believe, here in the live. All right, let's see your deal. Check around, what is this, 16, 17 min in, if you're not. All right, here's another deal. So you saw my videos on single family over multifamily and got me a little interested. So I started running some numbers on a single family, but either my numbers are off or these deals don't make financial sense. Yeah, well, here's the thing. It's all a down payment question, right? But let's look at the numbers you got. So just so it's easier, I want to sample a home close to you, and please let me know if I'm breaking down the numbers correctly. Oh, okay. So you picked a deal in Ventura. That's interesting. All right, let's look at the one you looked at. You know what we'll actually do is I'll pull up the multiple listing service because it's over here, and let's see what numbers you're running. Now you're picking Ventura, California to run numbers in on a single family house. Ventura, California is not exactly known for cash flow. Yeah, or nothing in Southern California really is. But let's see what you picked. So, okay, yeah. I mean, not particularly where I'd be super excited to dive in, but okay. So let's see. Yeah, I didn't recognize the street name at all. Let's pull up what you got here. So this is a $470,000 house. So I'll share this here. What you did is you kind of went looking for one of the cheaper houses in the area, right? You see, look, we're close to Bristol Road here. This is a section of town called Montalvo, which there are a ton of apartment buildings here. Not super excitingly desirable in terms of long-term ownership, wedge deals, just because you're not really going to see that upside potential and value, especially for an original property like this. You're, $490, okay, even if you renovate it, it's still not more than like a $550 neighborhood ever. So, another example might be something like, not Victoria. I brought this one up in another live stream. Let's see if they actually still have it on the MLS. Because I'm pretty sure that seller fired their agent. Oh, that's on hold. Oh, dear. Okay. So here's another one where, in particular, this is an example of a fixer-upper here, but it's in a particular neighborhood where I know that if let's say you bought this house for say $480, and then you put $50,000 into renovating it, it'd be worth somewhere around $600,000. If you spent more, it might be worth around $629. This is now where you're capitalizing on the wedge, right? If you're into the deal for $530 and it's now worth $6 to $630, that's perfect. That's the kind of deal that you look for in areas that don't cash flow very well, which those are going to be your higher priced areas. You can now swap that and go on over to areas of Texas and Florida, and you can get a certain wedge deal, but then you could also find yourself getting a 5 cap or a 6 cap or a 7 cap. That's just the nature of how the market has priced properties in areas like Florida and Texas or other parts of the country. And a lot of that is because of weather and market desirability, which creates that yin and yang that I describe for real estate investing. And what I mean by the yin and yang is you have appreciation on one side, you have cash flow on the other. When you have an area like Southern California, generally you see a higher rate of appreciation and a lower rate of cash flow. In an area like Florida or Texas, you'll see a much higher rate of cash flow, but a lower rate sometimes, not always, of appreciation. Overall, though, when you combine these, you tend to end up with exactly the same kind of movement in a marketplace unless there's a massive transformation happening. So what I mean by that is, if you have an established neighborhood in California and you have a 3% cash flow and 4% appreciation, you essentially, in my version, have a 7% cap for the yin and yang. You go over to Florida, you might have a 5% cash flow factor and 2% in appreciation in a similar area. You still have that 7 cap, right? Now, the only time this is different is if, for whatever reason, you find an area that has been depressed for a long time, and then you get some gentrification happening, which accelerates the appreciation and sort of catches up the market to the rest of the areas in the country where people are investing in. But I usually don't recommend you try to spread yourself too thin finding these. I recommend analyzing what is the backyard that I'm investing in. And, you know, whether this is Idaho, this is Utah, this is New York City, this is Brooklyn, I don't really care. Whatever the backyard is you're investing in, find the best sizzle hot areas within that area and then find good deals within that particular area. But now, you know, that's sort of my, my premise, no matter where you're investing. The goals that you should be following. So now let's look at the numbers that you have here. So let's pop on over screen share. And you know what? Let's hold on. Let's do this too. Let's open up numbers, and we'll do the numbers the way I might do them. So we'll just pull them up here on a number sheet, and let's just see what you have and compare. Okay, perfect. Now we'll share. Let's see what we got. Okay. So you pick the deal for $470 over here. There's no way it's going to rent for $2,750. You know, it's probably going to rent for, honestly, like $2,600. You know, if you're lucky. And certainly it's not going to rent for $2,600 in that condition. It's not a good deal. That one's a bad deal. It's a bad area. This, I think, is a bad place to start. Is, you know, when you do 10% vacancy, 10% maintenance, 10% CapEx, plus insurance, plus taxes. You know, these are very, very high numbers, because what you're telling me is $2,750 times, you know, I don't know that this is necessary on any bit of real estate. You're telling me that you think you're going to operate this thing at, you know, a 30% expense ratio just for these things. I don't see it. 275. Look at this. That is just for maintenance, vacancy, and capital expenditures. You're telling me you want to spend $825 times 12, almost 10 grand per year. I mean, 10 grand per year is like replacing a roof every single year. That's a lot. That's mismanagement. That's not correctly managing vacancy. I also did a video on vacancy factor, which you should check out that video on vacancy factor, where the average amount of time it takes to rent a single family house is under 1 week, which single family houses turn over less, right? So you have less expense there. Certainly not $275 per month. Then, you know, maintenance and capital expenditures. I mean, maybe if you're dividing out the actual reno that you might put into, that would be great. I personally would renovate a house like this first, because I would want a higher quality tenant. I wouldn't want 1970s property on the market in 2019 for rental. You know, and then so even here, then you say that, hey, well, let's say you could scoop up the house for $400,000. Let me just tell you right now, it ain't gonna happen. You're not scooping the house up for $400,000. If it's listed for $470, you ain't gonna get it for 400 grand, unless for some reason you're coming in with some cash offer and the seller's like super motivated to sell, and the seller doesn't realize they could just drop the price to $449 and get multiple offers. Sure, you could land that kind of situation, but it's not realistic. And I think the big thing is I always want to share with you, you know, what's gonna be very realistic, and this is this particular market. So realistically, we're not going to look at you know, any kind of craziness in that aspect. But now let's actually do the numbers and see what the cash flow would be if you did you know, some other mortgage calculations in here. So let's do this. Let's go to mortgage calculator. Let's analyze let's assume you got it for $450. Okay, you got the house for $450,000. $450,000. You put the minimum down on an investment property that I recommend of 25%. You're gonna have a higher interest rate of about 4.75% unless you live in it first and sort of house hack it, right? This is still going to be a negative cash flow. The way I would look at this is I would personally do 2122 as your principal and interest, not passive income, principal plus interest. Are we screen shared? Yeah, perfect. So this is the way I'd roughly do it. And remember, I always like a new spreadsheet. And I mean, not necessarily. I mean, I do have spreadsheets for analyzing deals. I'm still gonna do a lecture on that one day. It's just a very complicated spreadsheet, but I never want people to think you need spreadsheets. I don't use spreadsheets when I analyze them. I kind of use it to confirm and compare to other deals. I'll explain that in the future. Anyway, property taxes on this deal are gonna be about $470 per month, which, just FYI, I don't know where you got the property tax number from, but this is gonna be over $5,000 a month. Then you can have insurance on the deal. Renters and landlord insurance, probably about $60 a month. Then we're gonna do, let's be conservative, and I usually like to go with $200 per month, but I'm gonna go ahead and say, let's go ahead and say, hey, you know what? Go $200 a month for repairs after you actually, renovate the property and get it sort of up to speed. Maybe spend $30,000 cleaning it up. So now you've spent quite a bit of money on the deal, right? You've spent $142,000 on the deal to get in. You've put $142,500 plus some closing costs. You just dropped $150,000 on the deal. And if anything, if you get $2,600 a month, you're negative on it. It's not good. It's definitely not good. You're not buying in Ventura, California for cash flow. That's why a lot of people aren't buying units for cash flow either right now. That's just the nature of the city. You can spend $2.4 million on an 8-plex we have on the market right now, and even with the owner doing owner financing on it, it's a terrible deal. Totally negative cash flow. It's just not the kind of deal you want to look for in the area here. So instead, we look at this and we go, okay, we know it's going to be a $200-$300 negative cash flow. You have a property manager involved. Yeah, you're going to have a negative cash flow of somewhere around $500 to $600. And we get this a lot in the area here. We go, oh my gosh, it'd be a $500 to $600 negative cash flow. And so what you have to look at is you say something like this. You say, okay, if I have a $500 to $600 negative cash flow, that's going to cost me let's see, it's going to cost me $6,000 to say $7,000 per year. I need to get a really good wedge deal if I'm going to invest in a single family house. Or you put more money down to where it makes sense to cash flow. That's the only way the higher expense areas work, like Southern California. So for example, let's say the numbers are pretty similar. You buy that house that I showed you on Glenwood, and it's worth, $615,000, and you bought it for, say, even, the same price, $470, $475, whatever, something like that, $450, whatever, plus or minus the same thing. Now you look at this and you go, okay, you spend your money, you're into it, you just got a wedge deal of $80,000 to $100,000. Now you look at it this way. You got a wedge deal of $80,000 to $100,000. Even if you had a little bit of a negative cash flow because you didn't put enough money down to make it, ideally you get break even, right? Ideally, in a high expense area like this, you get it to where the rent's a little higher, it's a break even deal, or you get it as a better wedge deal. The Glenwood deal would be a break even deal if you bought it. So let's assume it was break even or slightly negative. Now you have a wedge deal of $80,000 to $90,000 to $100,000. Your net worth instantly jumped by that amount. Now what else are you getting? Well, you go over here to the amortization schedule. Again, high cost areas. Now you're getting an $80,000 to $100,000 wedge. You got principal pay down of somewhere around $5,000 per year that you're paying off in principal. Plus, you're going to have a taxable benefit most likely because a break-even deal generally provides you with tax benefits and some kind of paper loss. In addition to that, you have the biggest aspect of real estate in expensive areas, which is appreciation. You see a movement of just 1%, that's another $4,000 a year. 3%, that's another $12,000 a year. So that's why I say it's so important to analyze the particular market you're in and not try to compare Florida real estate or Texas real estate where you get 7 caps or 5 caps to an expensive area like New York or Southern California and suggest, oh, well, these cap rates are terrible. Why would anybody invest in this? Well, why would somebody invest in a break-even deal in a high expense areas? In a high expense area? Wedge deal, appreciation, principal pay down. Nobody cares about the cash flow in the expensive areas. The people who care about cash flow don't go to the expensive areas. They go to cheaper areas. It's what it is. All right, let's get on to the next question here. Oh, wait, you might have a couple posts here on the live. Okay. So how much do I factor in terms of, CapEx, maintenance, and vacancy? I mean, usually my capital expenditure is how much money I spend as my renovation up front. And after that, once I get the property situated, remember we didn't include a manager here, but for my own properties, I set aside $200 a month. I manage them myself with Lauren. Obviously, I always recommend you use a manager, but figure out your numbers appropriately. And I set aside $200 per month after I fix up the deal. That's been consistently perfect for me. In fact, it's been so good for the last, 10, 12 years that $200 per month, because tenants usually stay 3 to 4 years on single family, just keeps growing in the accounts. And then if, I need a big repair or I need to renovate, I've taken money out of those accounts and like, okay, cool. I'll take some money out and go invest it over here. And I always try to leave, $5,000 in each property file, just so, if let's say a roof replacement comes up or something larger, which we know a couple properties need, the money's already there. So some more good questions though. Really appreciate that. I think that's going to be very helpful for a lot of folks wondering the difference here. At least my POV on that. So, all right, let's continue on here. What else do we have? So we have Financial Freedom's deal. Let's analyze his. So analyze check around 32 min in today. Oh, well, I have to trim the live stream, so there's a little bit of a problem with that because I let it play for the first 10 minutes, but that's all right. We'll figure it out. I'll trim that down. So 32 minutes in, we've got a deal here. Let's see. We'll analyze this together. All right. So we'll answer your question. What monthly? Let's hit this really quick. Michael asks, what monthly cash flow? Okay. Amount should we aim for a rental property? I'm looking at a fourplex, but the net income after expenses and mortgage payment is only $85. This is very common. Hold on. There we go. This is, unfortunately, it's just very, very common right now in the marketplace we're in. And the only way you can really get it to cash flow more is by putting more money down. Now, that's not to say you should be happy with an $85 cash flow. What you should be happy with is, are you getting a good property? Are you getting a good deal? That, to me, is the biggest thing. And so if you're looking at a 4-unit building, in where did you say you were? Toronto, Canada. Come on, Toronto, Canada. It's expensive, right? Great area. We've had a little bit of a tough last 12 months, but a lot of the country has, Canada and the United States have had a little bit of a rough last 12 months. But to me, I look at that and say, look, if you can get into a fourplex and you have a cash flow of $85 and it's around the area of Toronto, Canada, that could be great, but it's not what I would hang my hat on. Because when you look at that and go, oh my gosh, I have to put all this money in and then I'm not going to have a cash flow, I think you really have to ask yourself this. I think this is probably the most important thing to really, really internalize. What do you want more? Do you want cash flow because you want to say you have, this passive income of, oh, I got, $500 of passive income. It's $6,000 per year. It's not so much. Or are you trying to build long-term wealth so that when you, 10, 20 years go by, your properties have appreciated to the point where now your net worth is in the millions, where now all of a sudden it's like, okay, $500 a month in cash flow, maybe it'll happen anyway because it's going to happen anyway as rents go up and your mortgage payment stays the same. It's cash flow in the long run, right? You start at something with $85. Watch this. Start at something that's $85 cash flow now. Every single year, you raise the rent $25 per door. That's it. And that sounds really, really small, right? But watch this. $25 times 4 is $100. at $100 times 12. That's $1,200 per year of extra cash flow, raising the rent just $25 per unit on your fourplex. Over 10 years, after 10 years, that's an extra 12 grand in income there, right? That's great. And now, after 10 years, you look at it and you say, okay, well now I've raised, actually, hold on, no, it's more than that because it's cumulative, right? Every year you're going up. So I did the math there wrong, sorry about that. It's actually much more than that because watch this. After, let's go on a spreadsheet here. This will actually be really fun. Let's do this together. So watch this. Let's go to the screen here. Let's do a little thought experiment, okay? You have a fourplex, and year 0, you have an $85 cash flow. But then year 1, you know, we'll go, well, how can I do this really fast? We'll just do it like this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I know there's a better way to do that, but I don't care right now. Okay, so let's just do this. Plus 100, right? So every single year you're gonna do this until you get to, well, if I'm gonna do year 0, you're about here. So your cash flow at the end of 10 years, only increasing the rent $25 per year per unit is now $1,000, and that's not assuming that the rental market has really bumped its interest rates. Oh, darn, my nose is bleeding. That's a problem. Let's just do that, and then you don't have to see me. Oh, I happen to have a napkin here. Wow, that's terrible. I've never had that happen before on a live stream. Anyway, so that just shows you with minimal rent increases of $2,500, you're building in this long-term cash flow here over time. But this isn't really where you want to make the money in Toronto. I mean, who cares? This is like a little side bonus, right? Where you want to make the money is the fact that you're paying off the loan, the fact that you're getting appreciation, you're controlling a 4-unit apartment building in Toronto, Canada. An area that I'd probably be pretty bullish on. So, you know, that'd be a big excitement for me. So, but feel free to give me a little bit more details. This is simple, right? And remember, this is extra monthly cash flow. So let's look at this annually. Watch this. Let's just be rude about this. Right now, your cash flow, you're saying $85 per month, which this is month, this is year. Watch this. Look at that. So now all of a sudden you take something that has no cash flow, just over time, you're holding it for principal paydown. You're building wealth by ideally getting a wedge deal. You're building wealth by leveraging appreciation. And now all of a sudden you have this passive income that develops over time. I think we're so caught up in, I need this number to be big today. Otherwise, I don't want to invest in real estate. If this number's too small, I ain't going to do it. You have to ask yourself, are you trying to retire today? Right? Real estate is a long-term wealth builder. And that, to me, is what makes real estate so exciting, because you take the income that you're making, you throw it into real estate, knowing that in the future, you'll be able to retire better than anybody else because you actually got started. So many people don't want to get started. And oftentimes it's because we spend a lot of time doing over-analyzing. We get into analysis paralysis, and we don't end up pulling the trigger on something. So let's do another deal here. Okay, so financial freedom. Sorry, that was supposed to be a quick question, and I kind of didn't answer yours. So let's get into yours here. So look, Houston, Texas. Let's see where this is. First of all, let's see what we got. You know, first things first, right? You got bars on every single window here. Not only do you have bars on the bottom floor, you have bars on the top floor. Look at that. Off the roof, man. What's going on over here? So this is always something you want to keep in mind when you're investing in real estate, is what area are you investing in? And sorry, I'm not visible here. I don't know what's going on, honestly. Yeah, okay. Anyway. So here's the Zillow deal. Look at this. Investor special. Really? So it's 4 studio units. Keep in mind, not a big... Yeah, look, you guys want cash flow. Here's your cash flow. This is no cash flow when you go collect the rent with a gun. I don't know the area, okay? So I could be being critical here. Let's go paste let's try to paste the area really quick. And another thing I do is I do something like, I want the map. I do something like Houston crime, right? Something like this. Let's see what we got. Yeah. Let's see what we can do here. I don't think I've ever done this before in a live stream. I tell you guys to do this, but I don't want to get in trouble. So I have to be careful with what I say as a licensed person. But anyway, you're by a nightclub, mechanics shop, metals, a restaurant, a tire service center, manufacturing, beef products. That's pretty commercial, man. I mean, look, you're kind of sandwiched here in a pretty commercial area. So what? I have to pay? Okay, here we go. Crimes. What is a condition alert? I don't know. I've never used this website. It's kind of cool. So I guess it doesn't want to let me look. But anyway, I probably pay for reports like this in your area. So, initially that makes me not so excited, right? I'm also not so excited that you're talking about 4 studio units, which 4 studios is, not, I mean, there's a lot of turnover you usually get in studios because they're small. People don't want to stay living in a studio. 2 units at the main house are $700 each and fetched $800, or 700 square feet each and fetched $800 per month. Why do they say and fetched $800 per month? Is that because they fetched it for they got lucky for 2 months? And then the tenants bailed and now it's an investor special? I don't know, man. And they look vacant. Let's see what we got. Golly. They didn't even clean up the tub. Oh, I'm dying here. Wow, how do you rent it like this? See, this is the thing. It's you want cash flow. Look, you got something that has a towel bar that's way too high. This is so funky. It's not even, set up correctly with a countertop. It's obviously a fixer. I mean, this is extreme. I'm not sure what's going on here. Black cabinets. Weird kind of placement here for the stove. They put a picture of a railway in, although wherever that is, commuter rail. Okay, so what do we got? We have 100 days on Zillow. This has been sitting around. I don't know, man. It's not. It's certainly not exciting to me. It's on a busier street too. At that, what else do we have going on in the neighborhood here? Let's see. This is where you get people, and I could be wrong, but this is nicer. Look at this one. This is good. I like it when you see newer construction like this around, because this is look at that. That's a nice one. What is this? Tri-level townhome. Sold for $360,000 in the same area. I mean, that's great. Maybe maybe I'll stand corrected, and maybe see, this is what happens when you get this sort of gentrification. In fact, I want to do a video on this. The New York Times, where is it? The New York Times just had a really big special on exactly this. I don't think I'm gonna, oh yeah, here it is. Watch this. Let's see if I can pull it up here, one sec. Okay. Watch this. I think I showed this in one of the last live streams, right? I want to make a video of this. The neighborhood's black. New home buyers are white. And while that sounds racist, they talk all about how possibly what you're seeing here is what you're going to see in more areas of the country, where you see these sort of older properties have new construction come in next door and start selling. And look at that. I mean, you got new construction here. Look at that. Wow. Brand new construction for $375,000. And you could get a duplex for $240,000. I mean, that's awesome, right? Let's see if we can get some sold comps of duplexes. So just be comfortable with the area that you're investing in. Apartment home for $312,000. Wow. I mean, if you could get an apartment for $312,000 and you could get a duplex for $240,000, that's great. I mean, honestly, this is a very good sign. This makes me a lot happier. Look at how new everything is around here. This now is starting to get exciting. Every comp I'm looking at is new. Here's an older one. No, it's not. It looks older. It's built in 2015. All of this is brand new. This is incredible. This is what you're seeing in Texas and Florida. It's exactly what you're seeing. So what do we have here? Single family house from 1925. See that? It's just the original areas are now getting gentrified. And yeah, in such cases, it's not a bad idea to be able to get in as long as it's not a high crime area or a lower class neighborhood in terms of one where you have to essentially collect rent with a gun, as they say. Be careful. And again, there's nothing wrong with investing in cheaper areas, but you don't want constant turnover. You don't want to be afraid of your tenants just to force a cash flow. So, okay, here's finally an actual comp. We have a single family that sold for $170. That was a 3-bedroom, 1-bath. Look at that. That's actually pretty move-in ready for $170. That doesn't make me so excited actually about the price of your duplex, because that's really nice for $170 for a 1925 property. So at this point, then you want to flip the argument and you go, okay, what can I get a duplex? What is this? This is another single family. What did that one sell for? That one sold for $240, but it's a 3-bedroom, 2-bath. What's this $340 over here? Here we go. $340,000. See, that's better, but it's larger square footage. Yeah, okay. So, I mean, hey, if this is what's happening in the area and you're getting all this new construction coming in, I'm more excited than I was initially. Much more excited. So let's see what else you wrote here in the deal analysis chat. So, because you sent me something from your broker. She has her own 8-unit property a half-mile away. Oh, good. And she's going to put in $60K to renovate, I imagine, not rebuild. So let's see if we can get this a little larger here. Okay, so you guys think the value is $237, which is pretty dang close to the actual listing price. I think I'm alive again. So let's say, okay, these are costs. That's fine. Taxes a little higher. Interest rate, 5%. Okay, that's fine. So why are you getting hard money financing? Oh, this is a comparison. Oh, is this for the down payment? Refinance loan? Oh, okay. See, this is what I don't like about spreadsheets is it's like, I can't, unless I have the actual spreadsheet, I can't double check numbers. So usually I just have to go redo this myself. You get $2,900 for the thing in rent. I mean, see, this is what I mean. This is where you get, the Texas money. So $10,000 down. You're not doing $10,000 down if you want to, rent it out. Let's do this. Let's go with a conventional form of financing. Let's assume you get it for $237,000 as your agent says. Now, the taxes that you're suffering, I shouldn't say that. The taxes that you're paying are, where do we have them? Annual property taxes. So they're about $550 a month. So let's get back to our mortgage calculator. Where did I put it? Here it is. Mortgage calculator. Okay, so you're going to be around $1,236. Let's hop on over to a spreadsheet really quick. Let's just do it here. You're around $1,236. $1,236 for principal and interest. Your property taxes are around, P-taxes are around $550. Your insurance, we'll just go ahead for a duplex, we'll say $80. That might be a little high, but we'll just say $80. So now, and then let's go ahead and let's put aside $300 a month for repairs after you renovate it. And then let's say you have a manager as well. And a manager is going to charge you $2,900, probably at least somewhere around $200 a month. So let's see what you've got. Your total expenses on the deal are now $2,366, and you're getting a cash flow of around $2,900, and that's where Texas is nice, right? You see that, it's like, oh, that's awesome. Your expense ratio, yeah, okay, it's you could be a little bit more conservative if you want for set aside, but if you're really good at managing a duplex, you should be able to keep your vacancy pretty low and your expenses pretty low after you renovate, after you get it ready to go. And so now you have, you don't have, I mean, this is great. I mean, the numbers make sense when you go out and look at these Texas deals. They make sense in terms of actually having a cash flow. The biggest concern that I have is, you have an area that's gentrifying. You have an area of a lot of new construction. You have an area that is obviously evolving. Evaluate the crime. The deal looks fine. And see how low can you actually get this deal for. Because if it's been on the market, well, here it's been 23 days on the market on HAR, It said on Zillow, it indicated it was on the market for 100 days. Maybe it was relisted by a different agent. See what you can do to grind that deal down and possibly get a better deal. But it already, I mean, numbers-wise, you can pretty much buy anything in Texas and get it to have this kind of cash flow where you got, you know, $300, $400, $500, $600 of cash flow on a fourplex. Yeah, fourplex on a duplex pretty fast. So, I mean, great. That's awesome. So let's see what else we have here. It's being revitalized. My broker has her own property there. Lots of new construction. Yeah, exactly. Yeah. So obviously you had written that before I found out myself. But yeah, I mean, so overall, I'm excited. Obviously, do your inspections very well on this because it's an older property. I like that if this is the area that you live in and it's being revitalized, this is an area, yeah, you could absolutely then, if you know the area and you're comfortable with it, you could definitely jump in and get some good opportunities here. Again, I don't like that it's all studios. I think it's going to be management intensive, and it's probably going to eat into your cash flow. And this, what's very interesting here is this says each were rented for $500 each. You know, now all of a sudden that puts you at a break-even cash flow or slight negative. You know, two units in garage. Okay, that's what we're saying here. So they got 1,600. Okay, so this is 2,600 in rent. Yeah, that's what they're saying here. Your agent's suggesting 2,900 in rent. Maybe after updating a little bit, that could be accurate. You know, especially if you make it like a cute, newer, old home. So yeah, overall, I'm not opposed to it. You know, this is going to be funny math, I think, with this cash on cash return of the 33%. But I think this is where it's so easy to get caught up in spreadsheets like this that you don't look at the deal the way you should. Which to me, the way you should look at the deal is, am I getting a good price relative to what other things are selling for? That's your wedge. Now, does it make financial sense for me? Can I carry this? Does it make long-term sense? Is it in an area that's going to do well long-term? In this case, it looks like the answer is yes. But they're all studios, which is not so desirable. So now you evaluate, would you be better off finding a duplex that has two two-bedroom, two-bath units, for example, where you have less turnover? So I would interview property managers in your area and find out, hey, how often are studios turning over? Am I doing 6 months leases and they're 6-month leases and then they're gone? Or are people staying for a longer period of time, like a year or two, because maybe your market supports studios better? I don't know. Things to evaluate, things to keep in mind. So, folks, thank you so much for being here on the live stream. I didn't just have a weird nosebleed. I would keep going for a little bit longer, but yeah, this is we'll catch up with this. Thanks. Folks, thank you so much for being here, and we'll see you on the next live stream when crazy things like a nosebleed during a live stream don't happen. So thanks again. Hopefully this was very helpful. I know there was a lot of talking here, but hopefully it really helped change your mindset on how you view real estate. See you soon.